keeping your politics out of your investment decisions, is this a good idea? Yes or no? Well, hi, I'm Scott Hamilton, certified financial planner. We're fee-only fiduciaries, have offices in Austin and in Houston, and we help people plan for retirement. So today we thought we would do something a little bit different, and we were going to talk about market returns during the election year. This is courtesy of Dimensional Funds. They helped put this deck together. It's a lot of their research. So if you would take a look, it's number one, it's difficult to tell. If you try to predict which way things are going to go based on politics, it's just a bad situation. Half my clients are wanting to, sell whenever so-and-so gets elected. The other half wants to buy, and people want to move to cash, and they're very concerned about politics. And in the end, my comment always is, we have a financial plan. We have got your risk tolerance. Let's stick with the plan. Don't worry about the politics. Don't allow political issues to come in front of you and your investments and your retirement goals. So we're going to go through a few of these slides. We'll ignore most of them. And it's kind of interesting to see. The bottom line is the market, since 1926 to now, has just continuously gone upward over time. There's trouble, but on average, that's what it's been. Okay, so this slide I know is very difficult to see, but you can notice the little red and the blue lines. This is the monthly dispersion of whenever there's an election, right? So that's just one. It's widespread. You can't really make a clear pattern out of it. Now, this is returns during and after U.S. election years in between 1928 and 25. So it's, for the most part, the market's up 3/4 of the time on average, just to begin with. 25% of it is down, and that kind of plays out here. But notice there's a lot of green, a lot of blue on the positive sides here. And we'll skip this one. All right, so this is the annualized returns during a U.S. presidential term. This is for the average for the president. It's 10.2%, the average. Notice Great Depression, Herbert Hoover, down 30%. For the most part, Nixon and Bush had negative annualized terms, but other than that, they're all positive. And I'm not sure you can make a difference between the reds and the blues. Obviously, red are Republican, blues are Democrats. And so we'll continue on. This is a good slide here. This is the annualized returns during U.S. presidential terms for the bonds, and it's 6%. Same thing, similar story. Biden had a little negative term, Carter a little bit. Everybody else is pretty good. This is the money shot right here. Markets have rewarded long-term investors under a variety of U.S. presidents. So notice, so here's Hoover over here again. That's the Great Depression, if you will. And then since then, we've had red, blue, red and blue, red and blue, and different presidents. The bottom line is you can't really draw a conclusion from looking at a chart like this. So my comment to the clients always is to keep your politics out of your investing. Invest straight. Make sure it's simple, broadly diversified, and low cost. That's my overarching philosophy. Anyway, so in summary, keep your politics out of investing, and you'll be better off for it. If you have any questions, visit our website, Hamilton Financial Planning. Arrange a Get Acquainted meeting for us. I'll send you this deck if you wish. And thank you for your time.